Hey guys, my name is Jim Keaty with Keaty Real Estate, and this is your COVID-19 market update brought to you by Timmesch Kastner Insurance. All right, so the last few months have been one hell of a roller coaster ride, but if you've been watching, we're keeping a very close eye on home values and the state of the real estate market before COVID, BC, during COVID, DC, and how COVID's going to affect our market going forward, AC. So this week I'm reporting on year-to-date numbers up to Saturday, April 25th, 2020. We typically do our market reports only once a month, but because of COVID, we're reporting week to week. This week I've got some very interesting numbers for you, and so as promised, here's your weekly COVID-19 market update. And just to recap, we can't start talking about 2020 without talking about 2019, the best year on record for sales and dollar volume for Lafayette Parish. That trend continued into the first quarter of 2020, and we started the year off with record-breaking numbers. We reported the best first quarter in Lafayette Parish history with a 17% increase in sales year over year. We had an outstanding first quarter compared to 2018 and 2019. Our average sales price is up $11,000. That's 5% increase year over year. Overall, going into this crisis, our market was very strong. It was very optimistic. How is the real estate market going to hold up during COVID? And in order to see that and to see the effect that COVID has on our market, you have to break things down week by week since this crisis started. As you can see here in Lafayette Parish, we reported 12% fewer solds March through April 25th, and 57 are 6% fewer year to date. So it could look like COVID did not have much of an effect on our market when you're looking at the sold data. But however, solds can be a little misleading because most of the closings in March were already in progress BC, before COVID, meaning buyers already had houses under contract and were in the process of purchasing the houses that closed in March and April before COVID hit Louisiana. Real estate has about a 45-day lag time. So sales we had today are actually homes that were put under contract typically 35 to 45 days ago. So to get a better indication of how COVID is affecting our market, we're going to take a closer look at some better lead indicators. And pendings are a great way to see how our market is reacting today. So although pending numbers were strong in the first half of March, the second half of March is when we started to see that negative impact of COVID-19 on the market. When the schools were let out on March 16th, we saw a significant decrease in the number of pendings going into the third week of March. And that trend continued into April. However, it looks like we hit bottom around the first week of April in regards to pendings, and the pendings started to improve. The numbers started to improve through the last week we reported, and we saw a 33% increase last week in the number of pendings versus the same week last year in 2019. However, we're not out of the woods yet because we should expect our sales numbers to continue to fall over the next few weeks as a result of the lower pending numbers in March and in April. But overall, last week pending numbers are a very good indication that we may have hit bottom and we are on the rebound. Another great way to see how our market is performing today is to look at the number of actual showings, or what we call buyer foot traffic. That's the demand. All of the realtors in our area use a system called Showing Time to set up showings, and Showing Time reported a 37% decrease in the number of showings or foot traffic compared to the same weeks last year. However, it does look like foot traffic also hit bottom around the second week of April, and I'm pleasantly surprised actually to report higher numbers for the last 2 weeks, with last week reporting a 5% increase in the number of showings week over week compared to 2019. Again, it looks like buyers are back out looking at homes. This could be an indication of some pent-up demand from the 8 weeks prior to this, and now that some of the buyers are ready to get out and start looking. However, last week, the public thought that we would be out of the stay-at-home order on May 1st, but that's been extended another 2 weeks until May 15th. Again, we're not out of the woods yet, and we could see another dip in the showings and pendings with the extension of the stay-at-home order. We've also found that buyers are not looking at as many homes, so our showing to pending ratio is much higher than normal. If a buyer is actually looking for a house in today's environment, they need to buy. No one is looking at houses just for fun right now. And you can see that you can see this in the numbers of the showings versus pendings. We reported 37% fewer showings DC during COVID, but only 9% fewer pendings DC. And our showing to pending ratio increased by 25% from 6% before COVID BC to 7.5% during COVID. So this is an indication that buyers are looking, are very serious, and they're not looking at many houses before they're making a decision. We also want to keep a close eye on new listings coming onto the market. That's our supply. In this next slide, you can see that after the second week of March, we saw a significant decline, 63% fewer new listings coming onto the market the third week of April. But take a look at last week with a 3% increase in new listings compared to the same week last year. So we are reporting 19% fewer listings during COVID, but only 11% fewer listings year to date compared to last year at the same time. I think it's possible that some of the sellers were expecting the market to turn back on May 1st, the initial back to work day. So they decided to go ahead and get their house ready and put it on the market and start looking for another house in anticipation of things getting back to normal. But with the governor extending the stay-at-home order for another 2 weeks, we might see another dip in new listings in the next few weeks. We're going to be keeping a very close eye on how the new listings perform in the weeks to come, and to see if it continues to increase or if it was just if we were premature. In this next slide, you can see our average price has jumped around the last few weeks, which is perfectly normal week by week. But overall, we saw a $9,000 increase in the average price during COVID DC, and $12,000 or a 6% increase year over year. So how can this be? So looking at our data, we're showing a decrease in buyer foot traffic, which we talked about, of 37%, and a decrease in pendings of 9%. But we also reported a decrease in our supply by almost 20% compared to the same few weeks last year. And because home values are a function of supply and demand, our supply has fallen a little bit faster than our demand, our pendings, and we're seeing our average sales price increase. Now, coming into the 2020, we already had less supply, active listings, and that trend continued and decreased even further after the governor's stay-at-home proclamation on March 16th. Over March and April, we saw a 22% reduction in active listings on the market and a 16% year over year. However, this is not necessarily a bad thing, since our demand, our buyers, has also decreased. The low inventory is keeping our prices stable, and the average price has actually increased 5% during COVID and 6% year over year. Therefore, we're seeing a reduction in the number of buyers, the demand, and a reduction in the number of sellers, the supply. And another way we can keep a pulse on the balance of supply and demand is by looking at months of inventory. And months of inventory is how long it would take to sell out every house that we have on the market if no new homes came onto the market. Supply and demand are in balance when we have around 6 months of inventory. When we have 6 months of inventory, prices are stable and do not change. But when we have more than 6 months of supply, that indicates too much supply and not enough demand, and we should expect our prices to fall. When we have under 6 months of supply, as we saw in the first quarter of 2020, that is an indicator that there's more demand than supply and prices rise. This held true in the first quarter of 2020 because the average price increased by 11,000 or 5%. So the balance of our supply and demand hasn't really changed, so we shouldn't see home values fall. As long as supply falls at the same rate as demand, our home values are stable. Going into this crisis, our supply and demand were somewhat in balance, just slightly less supply than demand, and that's why we saw a 5% average price increase in the first quarter. And as this crisis unfolded, DC during COVID, our supply and demand both started falling at the same rate, keeping supply and demand in balance with just slightly less supply than demand. And that had an impact on our home values by $9,000 or a 5% increase during COVID. And we're seeing a 6% increase year over year, year to date. Home values are going to hold firm during COVID, at least for now. We will not know what May and June will look like just yet, but I would expect our sales to continue to decline over the next few weeks as a result of the low pendings that we saw in March and April. I would also expect our sales to start to recover towards the end of May if things continue to move in a positive direction. I would expect our sales to be back on track probably around June, the first week of June. However, it's really a day-by-day, hour-by-hour situation. This is not a housing crisis, but it's a health crisis that is impacting the economy. So everything depends on when this health crisis is over so the economy can get back to work. Once we are past the health crisis, we're gonna have another challenge with the oil industry and the impact of the low oil prices will have on our economy. What we need to watch out for AC or after COVID is how oil prices are going to affect our economy and what impact it's going to have on our supply and demand. Will supply increase and demand decrease because of job loss in the oil industry? If people continue to lose their job not because of COVID but because of the oil prices, then we could see our supply rise and demand could fall, causing oversupply, under demand, putting downward pressure on home values. So we're not out of the woods just yet, but things are looking really, really positive, and I'm very optimistic. I hope in the next 60 days we get past this health crisis, and I hope oil prices stabilize and the energy sector gets some type of relief from the government. If you have any questions, please leave them in the comments below, and I will respond to all questions. Also, if you want to stay up to date on how COVID-19 is affecting our real estate market, be sure to like and subscribe to this page. We're going to bring you up-to-date information every single week about the real estate market as we navigate through this unprecedented time. Lafayette is a very resilient place, and we're going to make it through this, and we're going to make it through this together. I'm Jim Keaty with Keaty Real Estate. This market update has been brought to you by Timmesch Kastner Insurance. I hope you and your family stay healthy and safe, and as always, stay strong, Lafayette.